There's a brand new savings account for children that just launched. And I mean, it just launched. We're talking about the 530A accounts, also called Trump accounts. If you filed your taxes this spring and checked a box for your child or grandchild, you may have already gotten an email telling you it's time to activate. So, what exactly are these accounts? How do they work? And what are the real planning opportunities here, especially for your kids or your grandkids? Got all that and more coming up. My name is Mike Bernard. I'm a certified financial planner, and my team and I have spent over 2 decades helping families build retirement security and making wise decisions with their money. And part of that, a big part of that, is helping people understand new tools when they come along. Because when something new hits the financial world, there's always a lot of noise. It's a lot of headlines, a lot of confusion. Today, let's cut through it all and talk about the 530A accounts, what they actually are, what the latest updates are, and where the real planning opportunity lives. First, what is a 530A account? The 530A account, you'll hear it called the Trump account, was created within the tax law changes that happened last year. It's essentially a new type of savings account and investment account designed specifically for children under the age of 18. That is important. And here, the key thing to understand right out of the gate is it's structured like a traditional IRA. That's important. We're going to come back to that more in a bit. During childhood, the IRS calls this the growth period. The account has its own special rules, and it's different than an IRA at that point. But when the child turns 18, it automatically becomes a traditional IRA. And that's where the planning opportunity gets very, very interesting. Now, what's the latest news? Contributions to these 530A accounts officially open on July 4th of 2026. That's right around the corner. If you filed your 2025 tax return and used IRS form 4547 to elect to open one of these accounts for your child or your grandchild, the Treasury has been rolling out activation emails starting in May. You may have already gotten one. I got mine a few weeks ago. I got a reminder because I didn't do the first thing when I needed to. There's also an official app, the Trump Accounts app, that you can use, or the website trumpaccounts.gov. As of right now, about 6 million children have already been signed up. And if you haven't done so yet, but you want to, don't panic. You still can open an account doing so online or through the portal after July 5th. Or you can always work with your tax preparer and file Form 4547. Now let's talk about who qualifies for these accounts and how they actually work. Any child under the age of 18 who's a U.S. citizen with a Social Security number is eligible. There's no income limits. That's amazing. The child doesn't even need to have earned income, which of course is a big deal with an IRA. I'll explain why in a moment. The annual contribution to this 530A account is $5,000 per child. Parents, grandparents, family, friends, anyone can contribute. But just know that that $5,000 limit is the combined total from all contributors, not $5,000 per person. One other thing to note, contributions must be made by December 31st of that year. Unlike traditional IRAs, even Roth IRAs, you have up until April 15. That's not the case here. What about the $1,000 you've heard from the government? Well, this is the part that a lot of people have heard about. Likely you've heard about this feature. A child born between January 1st of 2025, that's last year, and December 31st of 2028, the federal government will make a one-time $1,000 contribution to the account. This pilot program contribution does not count towards that $5,000 contribution limit. So if your grandchild was born in 2025 or 2026, there's some free money waiting there. You just need to sign up for the account. And some private donors are getting involved as well. Michael Dell and his wife Susan pledged $250 for qualifying child age 10 and under and lower and moderate income zip codes. The point is there's momentum here. So if you may qualify for the $1,000 or the $250, make sure that you are taking action. Now, a key point of these 530A accounts is that they are investment accounts. These dollars are invested. During the growth period, while the child's under the age of 18, investments are restricted. You don't have a full menu of investment choices. The account must be invested in low-cost index funds or exchange-traded funds that track the broad U.S. stock market indices. Think like S&P style investing. Expense ratios are capped, leverage is not allowed, speculations isn't allowed. This is all intentional. The government wants these accounts to grow steadily and responsibly over time, even though it's volatile because it's in the overall stock market. It's a disciplined, long-term approach, and honestly, for a child with an 18-year runway, maybe longer, makes a ton of sense. Now, here is where I want to spend even more time, the real time, the planning opportunity. When your child turns 18, the 530A account automatically becomes a traditional IRA. Same rules at that point, same contribution limits from that point moving forward, and same tax treatment. Now, the contributions that were made to the account during childhood, they were made with after-tax dollars. So that portion will come out tax-free. But the growth, all the investment earnings, that gets taxed as ordinary income when you make a withdrawal. That's how a traditional IRA works. So you might be thinking, well, wouldn't a Roth be better? And yes, absolutely. And that's the key opportunity here. So here's the strategy. When your child turns 18, let's say they're heading into their freshman year of college, or maybe they're 18 and they're getting their first job, their income is probably very low, maybe zero taxable income. Maybe they're earning a little bit, but not a lot. And this is the moment to convert that 530A account, which is now a traditional IRA, convert it to the Roth IRA. Because the amount that you convert gets added to your taxable income for that year, but only the growth, right? Because your contributions were after tax. How much growth is there, and how much standard deduction or other deductions do you have? In 2026, the standard deduction is $16,100. And if your child has little or no other income, up to $16,100 of that Roth conversion of the growth could happen in a 0% federal tax rate. That's no tax. And if the account balance is larger than that, you spread the conversion over a few years, keeping them in a low tax bracket each time. The result? A Roth IRA. Started at birth, decades of tax-free growth, potentially tax-free for the rest of their life. Guys, this is a generational wealth tool. Now let's put some numbers to it that are almost hard to fathom. Let's say a family contributes that maximum $5,000 per year, every single year for 18 years. And if you can earn a 10% average rate of return on that, by the time the child turns 18, the account has grown to approximately $225,000 at age 18. If that account keeps growing, rolled into a traditional IRA, earning 10% a year, no additional contributions, guys, it's approximately $20 million by the time that child is age 65. Even at an 8% growth rate, the account reaches $185,000 by age 18 and roughly $7 million by age 65. Very different numbers, both though life-changing. And if you convert to a Roth IRA at age 18, all of that at a low tax rate, the growth on all of this is tax-free. The point is tax-free compounding over a lifetime. Now here's what I want you to hear. The 530A account does not exist in a vacuum. It's one piece, and like everything we talk about on this channel, it touches all 6 areas of your financial life. Your tax planning, of course, because how you contribute and how you time the Roth conversion at age 18, it matters enormously. Your estate plan, because these accounts raise some gift tax questions that need to be worked through carefully, but it also begs the question whether you should be funding these accounts throughout your lifetime instead of leaving a large inheritance at the end of your life. Your cash flow, because you need to be intentional with your cash to see where does this fit in? Does this extra $5,000 fit in your lifestyle and in your cash flow within your own one plan? The point is, guys, this is a planning conversation, a comprehensive financial planning conversation. And the families that will get the most out of these accounts are the ones who take a step back, look at the full picture, build a strategy, not just open an account and throw some dollars into it one time. Work with your certified financial planner on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.